One property, although it can be life-changing down the road, is not financial freedom, which in most cases is why you start getting into real estate investing. One property is just a side hustle, and often after that first property, you hit a wall on how to find the next one. So let's be honest about the current market of rental properties right now. You might have a rental property under your belt. Maybe it makes a couple $100s a month, which again is not life-changing money. You're in it for the appreciation, the loan pay down, the tax benefits, etc. And over time, that is definitely going to be a wealth generator. I don't want to minimize that. But right now, you want to get more, but you can't because you've probably run out of funds, or you've run out of deals, or you've run out of time. And all three of those obstacles are things we're going to talk about in this video and how to overcome all of them so that you can build an actual portfolio in real estate. Okay, and step number one is with your current property, both your rental property and your primary residence, it's understanding what is your actual net worth? How much equity do you have in those properties? And this is where you need to have a good understanding of what both those properties are worth. And so I do provide free evaluations for investors that allow them to understand if they wanted to refinance or get a HELOC, how much money could they pull out of their property. If you don't want a free evaluation, it's a great opportunity to chat with a bank or a mortgage broker who have experience with rental properties specifically. Now, a lot of you might know this as the BRRRR method, the B quadruple R, in finding a property, renovating it, refinancing it, and pulling your equity back out sooner rather than waiting till you have to sell to liquidate. The problem, or maybe not the problem, but the difference is if you've owned this property for a lot longer, you've had some natural appreciation, you didn't have to force it through renovations, you still might be able to BRRRR, it's just been a couple of years. Okay, so let's talk about the first problem, which is money. Most people who end up buying rental properties have either saved up a lot of money and purchased their first place, and then they don't have access to money down the road. An important part of this process is understanding with your current rental property and your primary residence how much they're worth and how much you have in equity, because you can actually use that money to purchase further properties. So if you don't know how much your properties are worth, I'm happy to provide a free evaluation for investors so that you could take that to the bank and understand if you were to get a HELOC or refinance and do sort of a version of the BRRRR, which is the B quadruple R, then you could take some of the money and buy your next property. But the problem most people have is when they buy that first one, they run out of funds because they're used to just saving up X amount through their paycheck and whatever, but they don't want to wait another 5 to 7 years till they have enough money. And most people don't want to start a real estate investing business where they have to raise capital or money from other people and pay those investors or take hard money or stuff like that. And so the best method to start is by looking at your current assets and understanding if you can leverage those into purchasing more. And this is where, if you want to understand a good metric, it's called return on equity. Okay, so if you look at how much cash flow a property generates on an annual basis and divide that by how much equity you have in the property, that will give you a number called your return on equity. It's different than your cash and cash return because it's telling you, that $200,000 that you have in that property is only making $100 a month. But if you took that and bought a different property, you could be making $300 a month. So it'd be better to take that money out and put it into something else. Okay, and let's say you even have the money. A lot of lenders are getting very sticky on having multiple mortgages. And so then they often want you to form a corporation, which usually means you have to put 25% down, and then your corporation doesn't have any lending history or any credit history, and so you're sort of stuck. You think maybe I'll transfer my property into my corporation, but then you have to pay land transfer tax again, and then you end up not doing anything, and now it's been 3 years and you don't have any more rental properties. Okay, and so there are specific programs that some banks and some credit unions offer specifically to real estate investors to help them scale. But sometimes if you have a relationship with preferred bank or credit union A, you might max out there and have to go to bank or credit union B to get a new profile started with them so you can get some more loans for new properties. Okay, and the second problem that a lot of people face is maybe their property is a little more work than they thought, and now they're stuck with a second job, and the thought of scaling into more and more properties is kind of scary because you're already totally maxed out for your time. And part of buying rental properties is to have a passive income so that you can eventually have all of your time be freed up because you have financial freedom. It's called freedom after all. You don't want to be working 2 jobs. And so while it may be intimidating to buy a second property if you own that first one already and it's not going super well, chances are you probably didn't buy the best property or you messed up on tenant screening. Now, even if you did both of those correct, I would argue that now that you have somewhat of a system or an understanding of the work that goes into running a rental property smoothly, adding that second one isn't nearly as difficult. And maybe this is a bad analogy, but it's kind of like kids, where at some point there's sort of a diminishing return on how many you add to the pot. In terms of, if you have 10 or 2, you're probably stressed and really burnt out anyways. And so you might as well have 10 rental properties making you more money than just 2. This is not advice on how many kids to have. Okay, and the third one is the art of the deal, or finding the right property. And this is something that David Green used to be from Bigger Pockets has talked about a ton, which is portfolio architecture. And so if you have a property that's in a bad area but is a cash wagon making a ton of cash flow that isn't appreciating, I would probably push you to buy a high appreciating property that maybe offsets some of that cash flow. Maybe it just breaks even. And so on average, you make less, but you now have a more balanced approach to a portfolio. It's like stock investing. You don't just buy all the aggressive tech stocks, then you're subject to the ups and downs of the market. You want to have cash flow, but you also want to have appreciation. And so if you own a really expensive property that's appreciating really well, maybe it's worth your time to take less cash and go invest in something that's going to generate a lot of cash flow, especially if you have equity in that property, where you could take that equity and go and generate significantly more cash flow in a different part of town. Now, in terms of portfolio architecture, what is the right amount? I think you don't want to have an overwhelming amount of those cash flow properties, and I don't think the value in those cash flow properties should ever be more than the appreciating property. So if you own a $500,000 house, I don't think you should own 5 cash flowing properties at $100,000. In fact, I don't think you should own more than 2 at that rate. I honestly think a 1-to-1 ratio of cash flow to appreciation is a great place to start. Down the road, when you have enough of those appreciating ones, you could be a little riskier and take some more cash flowing properties. And this is something I help a ton of my clients with, orchestrating their portfolio of their real estate investments so that they understand which ones are making them money, which one is making them wealthier down the road, and how all of that together is helping them have both cash in their pockets today and helping them have cash in their pockets tomorrow. And so the next thing, which I'm actually not going to talk about a lot, is the roadmap for scaling, because there is a ton of knowledge out there in books and podcasts on, finding your team, building systems, going out and doing it. And I don't want to just regurgitate that. I don't have no interest in being that. What I want to talk about is why Winnipeg is actually a good market for this balanced architecture approach, because we have very specific zones that do cash flow quite well, that have very bad appreciation. And we have a large portion of the city that appreciates quite well, but does not have that good cash flow. But most of the time is still possible to break even. So we're not a market yet where you can't buy a single family home that breaks even. We're also not a market where it's some random place like Columbus, Ohio, where you're buying $40,000 shacks and making crazy rent, but then you can never sell the property. Okay, and so Winnipeg is actually quite balanced. What it does sort of naturally is it brings the edges of super heavy cash flow rundown properties and super high end luxury stuff, and it brings them closer together. And so we have less of a gap between those two properties, which allows you to maintain that balanced approach a lot easier. So this means when you are investing in Winnipeg market, you're not gambling. You're making asymmetrical bets with your real estate portfolio. And if you are right now wondering, well, where am I in my portfolio? What am I doing to build? What am I looking for an approach? That is a great place to be. And I think, if you're starting to think about next steps after you've purchased your first one, or maybe you've purchased your first property and you've made a mistake and you need help getting out of that, I would love to chat with you. My information will be in the description below. Reach out to me and we can book a meeting to go over your portfolio and how to craft it into the portfolio that you want. Thanks for watching. I'll see you in the next one.